Good morning, everyone. Once again on this Sunday morning, I welcome all the participants to the Valuation Manthan session number 22 on principles of value creation. This Valuation Manthan is a great initiative of Valuation Standard Boards of ICAI under the leadership of its chairman, CA Hansraj Ji, and its vice chairman, CA Priti Paras Savalaji, for the benefit of all the existing professionals as well as aspiring registered valuers. I request our Honorable Chairman, C.A. Hansraj Sirji, who is also a Central Council member, to give a welcome address to our participants.
Thank you, Anisa. Thank you. I welcome each and every participants. The star speaker of the day, Deepam Patel ji. He is a over and above a professional chartered accountant. He is a valuation professional also. You see, like the subject today, the principle of value creation. The word or the this topic itself reflects how the value to be created, what the parameters one has to start with to create a bigger organization or naturally bring out good for the each and every stakeholders, not limiting to the promoters only, but naturally touching to the creation of value for each and every stakeholder is a big task. Understanding, though we all understand with the person who is directly involved as a valuation professional, he'll be able to justice or he'll be able to get us more strength on the subjects. And same way, I am also hopeful कि Deepam ji will be able to make us more stronger at the end of the session. We'll be more empowered with our knowledge on the subject related to the valuation creation. And we well supported by the office team. Dimple is here, Rahul is here, and our moderator, Anisa Kaji, she'll be taking her to the sessions wherever the interaction or the question comes in. Tech team is also very supportive to us, and hopefully, this session series, though naturally over a period of this 22 sessions are over today, it will be a 22nd in the series. The series started with a great thought under the our co-chairperson Preeti Savla. She hails from western part of the country, me from the northern part. We thought of naturally the subject is such which is evolving, and for the benefit of the members or the for the benefits of the different stakeholders, it is necessity to be in continuance rather than having a seminar or the conference in one go and bring out everyone there, but rather it is the necessity because subject is such, it is not yet mature to the level wherever it requires to be. So we have to be in a consistent, and the concerted efforts will make us more better strength to be given to the members of the fraternity, whether it is a resolution, our valuation professional or otherwise members in general also as a chartered accountant. So with this initial thought, this program was being brought in. Going forward, I would like to share with each one of you this board as such is such a board where more on the service to be rendered with service to be given with, whether it is related with the standards which has already been developed and how to take them to the international level and how to bring out for the each and every regulator also to understand with how these valuation standards are useful in the business side or the otherwise wherever the stress comes in as a insolvency professional also, and wherever otherwise in the startup system ecosystem different level. So this board is really been quite proactive and bringing out such a good things. And same way I request each one of you, wherever you have the interest, each and every participant has been requested, wherever you have interest to involve yourself in the board, just send a through the mail communication or through the WhatsApp or the communication with me or co-chairperson Preeti Savla. We are with an open. We need the support of each one of you for the bringing out this board to the next level. With these words, I welcome each one of you, each and every participant, those who are participating in numbers, maybe running into thousands. Our speaker, Deepam Patel ji, the moderator of the program, Anisa ji, and the team at the office also. Thank you all. Thank you very much. Over to Anisa.
uh, Introduction of our speaker in the beginning, and at the end I request the participants, like during the session they can send their questions, which will be answered, the queries will be answered at the end of the session. CA Deepamji, he is a partner with Kantilal Patel and Company, a firm existing for almost 60 years. He is nominated as member of the advisory committee of the ICAI Registered Valuer Organization and Center for Audit Quality Directorate of the ICAI. He have been a regular and primary contributor to the various newsletter, key legislative changes, publications of the firm. He have been instrumental in educating clients of the firm for recent changes in the legislative framework applicable to them, including customized training seminars on various topics. He is a super specialized in the field of valuation of securities or financial assets. He has specific experience in international taxation. And the list can go on. It will take 20 minutes for me to give his introduction. So with this brief introduction, I request CA Deepamji to start today's section. Over to you, CA Deepamji.
Thank you, sir. Thank you, ma'am. I think at the outset, it would be, a great contribution that I can put on record that the Valuation Standards Board is putting for the valuation professionals. I think the 22nd session on this topic itself says the consistency and the quality with which these sessions have been conducted over the past. I've watched almost all of them except when I was traveling. And that too, on the recording, I watched everyone and every session. And I would say that the benchmark of quality is so high, it sends down some nervousness on me also, that I have to deliver to that level of quality for just matching the standard set by the Valuation Standards Board under the leadership of the chairman and the co-chairperson. I think these initiatives is what connects the professionals and also makes them understand the nuances of valuation. With that brief note of gratitude, I'll start my session. I'll first share my screen and I'll request Anisa ji to confirm on seeing it. I'll just share 1 minute.
Yes, sir.
Yes, ma'am.
Yes.
Great. Thank you. So I'll start with, opening the suspense that what I'll be discussing today, because one thing is that when we discuss about the principles of value creation, there's not much of any particular science or rule book around it. It's more in the session of it's more in the domain of getting to know what is valued by people. I think value, as we all know, it's the saying goes, beauty lies in the eyes of the beholder. So that way, value lies in the eyes of the evaluator. It's kind of that. If a person likes something more than what, so the desire level is very high, then the value in the eyes of that person significantly increases. However, at the beginning, what we'll discuss is what is it that you can expect from the session today. The first thing is that by the end of the session, as the chairperson mentioned, it's more about giving the the principles of creating value. So the first thing that we aspire as professionals by this by attending this seminar is that you can become a business value consultant or a value consultant or a business value architect or a value engineer. Like, these are the terms that is used in the consulting domain, that if you are in the field of consulting instead of going in the field of just compliance, so that's what you would differentiate yourself as a designation, or as a consultant, as a person. The second thing that we need to understand is what drives all the transactions in the world. So all transactions that are driven in the world are driven by value. Like if the buyer looks at something, they find value in it, and the seller also looks at the value in the transaction, that the buyer has to buy it and I get some value. Now, what of it is necessary in the field of consulting when we look at the principles of value creation, the end goal. The end goal largely is that we want to be people who add value to the clients. And to add value to the clients, it's more in the consulting domain that I am looking at this seminar to be. Most of the compliance domain part of it, like certification or even giving out and just carrying on a valuation analysis, it's most of it is historic in nature. The more so it's on the date, right? When you give the report, it's specifically for that date. Now, creating value is a process, and largely what we want to target is how do we participate in that process with the clients. So, if we look at the profession of valuation, we understand that there are registered valuers and even chartered accountants for certain types of valuation. Both of these domains are largely compliance oriented. Like if we look at registered valuer, the larger requirement is for compliance oriented valuation, and even for chartered accountants it's more on the certification part of it. Advisory valuation is something that you get to do, and at the same time you also you don't require a specific qualification to do it. Some of the valuations are even performed by good consulting firms. They may not be a registered valuer or a chartered accountant, but they are separately qualified or with experience and skill. They perform those valuations, and they are very well respected also. And what brings that respect is essentially the skill and knowledge. So my agenda for today is to give you that skill and knowledge, or at least attempt, to give as much as skill and knowledge that I have and share it with you. So, what is the ultimate outcome? If any activity is done, the ultimate outcome of an economic activity is profits. Like a person wants to pursue something for profits. So, at the outset, what I'll be limiting my discussion today is for profit entities. So, we understand that there are social enterprises, there are governments. They also add value to the society. However, their ultimate objective is quite different than what the objective is for profit entities. So at the outset, I'd like to put out this, point for everyone that today's discussion is going to be focused on for-profit entities. So what applies to a for-profit entity may not necessarily apply to a social enterprise or a government or any other organization with a motive or objective which is not to make value in terms of economic, like money. The profits which are there, which essentially quantify the value generated. So profits lead to cash flow. Once your cash flows are there, it essentially leads to creation of value. So the first objective, the immediate objective of any business is to create profits. Once it starts creating profits, the measure of that profit is largely in the valuation community also focused around cash flow. And once a entity generates sufficient cash flow, it essentially starts creating value. And I think as valuation professionals, we all are familiar with measuring or quantification of the value created by using a method called the discounted cash flow method. Now, the discounted cash flow method is essentially a tool to measure the value created. It gives you a barometer. It's more like a thermometer to measure the temperature. Similarly, the DCF method is there to measure the value that has been created. And it's unlike a thermometer where there is a clear reading of the temperature, but it's essentially a tool that is widely used to quantify the value that has been created. However, today's discussion is going to focus on how to create the value rather than how to measure the value that has been created. So we'll continue with what is the structure of our discussion today. The first and the foremost thing is, it's quite an interesting topic because it's trying to decode what every aspirational human wants to achieve. If we look at history, people have been aspiring to create value, and as a human race, everyone intends to create value. Now, value can be monetary, value can be social, value can be just positional, like for the government, or any other kind of value that you may consider. However, in today's discussion, we are going to focus primarily on economic value, and our agenda would typically start with the basics and go on to the principles that we would discuss, how we are going to move forward and discuss the principles of value creation. I have made some case studies because it's important to understand the principles in action rather than just looking at the theoretical aspect of those principles. The fourth aspect that we'll discuss is how do you become a value engineer or how do you become a value consultant? And the last part of it is to give you a formula for value creation. It's like the Einsteins or the Pythagoras or the Black-Scholes, for example. What they have tried to attempt is to quantify or give a formula for any aspect, like gravity, or for the Pythagoras theorem, or for the Black-Scholes method, which gives you an estimate of the option value. Similarly, how do you put a formula to value? And that's something that I'll discuss towards the end. But to get to that point, we need the clarity of concepts over all the initial parts. Also, as I discussed, over the past 22 sessions, we have, so for the past 21 sessions, there has been tremendous quality in the sessions that have gone. And I think that this is an uphill task for me, but I would try my best. And at the outset, I thank you for giving your time to me. Also, what we want to also keep in mind while we discuss the following slides is that when we apply the learnings from our session from today, it's more that you continue to keep these things in mind, which are more for your interest, and also to, shine as a realistic professional and not be a window dresser or a professional that is just sweet talker and not doing. So one is that we always have to maintain an integrity because window dressing does not help anybody. Ultimately, it is taken down. No false or misleading statements. So there should not be, means how to create value. You can create value by falsely making claims which are not sustainable. However, we want to keep our focus limited to all those basics being set right. I'm not going to get into much of those things and repeat all of this, because all of this keeps every is an underlying concept for every principle that we discuss. The third thing that we want to keep in mind is that all the stakeholders are important. It's, as Hansrajji mentioned, it's not only the promoter, it's not only the shareholders, the employees, the organization, the customers, the vendors, even the ecosystem. Everything, every item is a stakeholder, and all of them have to be kept in mind while you create value. And the fourth thing is that it has to be realistic. You know the principle, you know how to play with them, but then you apply them unrealistically, and that does not lead to a creation of value, but it creates a dream and it doesn't create a value. So I think these were some of the basic things that I wanted to get clear before I start my presentation. With this, I would like to now start with you know taking you through the process of value creation and the principles that underlie that. So the first thing that we want to understand is the term value. Now, value as a word itself is quite differently defined under the dictionary. So the Oxford Dictionary defines value for five meanings. It already has five meanings, out of which two are relevant for the purpose of valuation. So the first meaning is how much something is worth. Typically, it's very similar to what the definition of price is. What how the dictionary defines price is the amount of money that you have to pay for something. So when we look at value, it says how much something is worth. And when we look at price, we see that the amount of money that you have to pay for something. So the difference between value and price essentially under the dictionary is that value is perceived, whereas price is constant. So when you put a monetary term to a item, it becomes its price. And when you look at the non-monetary aspects to it, it becomes value. Now, it's very difficult to explain, but it's something that I would just want to put as a first concept in front of everyone. So that, under the dictionary also, value doesn't mean price. It essentially is how much something is worth. And it doesn't say for whom. So it kind of is something that has been loosely used. Plus, it's very difficult to explain. The second definition is how much something is worth compared with its price. So when we look at value versus price, how does price come up? So price is the fixed amount that in a transaction, if we were to look at as an example, the seller has put an offer for selling an item for a particular price. Now that amount of money that is set is becoming the price for that item, and how much it is worth for is in the eyes of the buyer. Now, if the buyer finds that this item is particularly valued at that same amount, then he would do the transaction and purchase it from the seller. If he finds it is not giving him the desired value, he would not participate in the transaction. So that is something, the first and the second relate to what we would look at value as a valuer. The third thing is the quality of being useful or important. It's like valuable, like the item is important to me or the item is of value to me, which means that we are not looking to quantify it, but we are just trying to mention that it's important to me. The fourth one is about the belief about what is right and wrong and what is important in life, which means the values that we as a Indian tradition have, or the values that we want to inculcate in the next generation, etc. So that's the fourth meaning of the term. And the fifth meaning is the algebra meaning, which is x is equal to 3, then 3 is the value of x. That's how value is defined. With that, what is the first principle of value? To understand the first principle of value, we need to rewind back in time and understand that the underlying and the most fundamental principle of value lies in the origin of the barter system. If we were to look at how barter system came into existence, it was essentially that a person wanted to trade goods for something else. Now, if we look at history, essentially all of the people in history had their same, uh, you know, they were self-sufficient. So they would do all of their activities on their own, be it clothing, be it cooking, be it eating, be it whatever. Even if they wanted to make footwear, they would make their own footwear. Then what over a period of time, wants and needs of the humans increased, and that led to the creation of barter. That if I spend doing one thing at a time, say for example, I just make footwear. If I start making footwear, I can make more footwear in a shorter amount of time. And I don't have to grow my own crop. I can exchange this footwear for somebody who grows crop and I can change it for it. And that led to specialization, needs, and that led to the creation of barter. The fundamental principle of barter was a value exchange. For example, if a person did not make crop, but he made footwear, and that footwear was exchanged for crop, the person who was giving the crop in exchange of footwear found value in footwear, and the person who was giving the footwear found value in the crop. So this was the genesis of barter, that there was a value exchange that was happening. And that barter then grew into an international barter, that spices went from the Indian continent to the West, and things from the West came to India, and things like that became the first known concepts of international trade, where even the barter system was there. So essentially value exchange was happening. Then came a point that not everybody wanted footwear, or not everybody wanted the same thing. And how do we value or how do we measure the value that is there? And that brought the concept of money. And the mode of transacting has changed. So essentially, barter moved into a transaction. Transaction became measurable in the context of price, and price was measured in the terms of money. And that money was the quantification of the value that was exchanged in the barter. And still date, any transaction, the underlying principle still remains the value exchange. And there may just be a quantification of that value exchange, which happens in the terms of a determined price. And today, as we know, we are in the world of UPI and digital payments. So the way we trade or the way we transact has undergone a complete change. However, the principles underlying that trade remain constant. That is, there is a value exchange that's happening in a trade or a transaction, and that value exchange is the key point that we need to understand to see how we can create more of it to offer and get more and more creation of that value. With that, the other concept that we need to understand is to understand the idea of an economic activity. As I've already discussed that today we'll be discussing creation of value for economic enterprises, that's for profit enterprises and not for social enterprises or others. We'll focus our discussion on economic activity. Uh, how do we say that there's an economic activity happening? It includes every activity which has a price or value in terms of money attached to it. So ideally, it has to have a price in terms of money attached to it or value in terms of money. So it either has a price or it has a value which is described in the terms of money attached to it. However, today's business activities have the potential to quantify everything in the terms of money, and that's where quantification of value has become a very important part of how businesses operate today. Within economic activity, the underlying genesis is the value that gets exchanged. And how does a business exist is through something which is called a driver. Like that's the basic force of the business. For example, if we were to look at a telephone company, and the basic driver that makes the telephone is the need to satisfy, which is the need of communication. Human beings have a need to communicate, and a telephone making company provides a device that satisfies that need. So essentially, there is a value that the buyer finds in that, and that value is being fulfilled by the telephone company. So that becomes the driver of the economic activity. Now, under economic activity, we have a further concept called the economic value added. And that economic value added can be based on the past assets or the future assets of the company. And if we were to look at, startups, they are more into high growth assets, which are more of the future assets. And when we look at established companies, it is more about the past assets and that continue to generate revenue. So if we were to look at an entity like a hotel chain, then they have their past assets that are continuing to give them more revenues in the future. So those assets already exist as on date. They have a capacity, they have the past track record to establish that this item is being utilized to this extent, and that gives them an idea that this is what it will generate in the future. So those are the past assets that continue to create value. And the second type of assets are the future assets, which becomes in, if we continue the hotel example, it becomes more hotels that are being added into the future and at different locations, which become the growth assets for the organization. So when we look at economic value added, how is it technically defined? It's technically defined as the return that the assets generate over and above the cost of having those assets. So return which is more than the cost of the capital for the business, that becomes your economic value added. And economic value added is a fundamental explanation of how a business can create value. And in accounting terms, I think we are all familiar with the term of return on capital employed or return on equity. And higher that ratio, it's ideally considered that at least financial wealth has been created or a financial value has been created based on those parameters. So considering this principle is very essential. And before, we discuss the principles per se, which is the second section of my presentation. The first section is mostly limited to understanding concepts, and within that concept, we have a very interesting, dichotomy of story versus numbers. Like what value a story has and what value uh, a number has to the entire overall arrangement of the business. Now, what is story and what is numbers? So, story is the qualitative aspects of a business. Uh, you'd try and understand this from an example of if we look at the Mastercard advertisements in the past, they were always, some things that money can't buy, and for everything else, there's Mastercard. So there's a story that they create around their product, which is not necessarily directly related to what they offer, but it's kind of a connection that people find, and they get to that point where they understand that okay, this is something that I can relate to, and that's why this particular item is relevant to me. And with that storytelling, they also communicate how they are fitting into that story. And that's where most of the value is created. However, numbers are something that is very essential for a valuer per se. If we were to quantify the value that has been created, you need numbers. You can't quantify a value from the basis of a story. So how it operates in the world is that a valuer, per se, a valuer who is a professional valuer, would respect the numbers more. So valuers are more about financial modeling, number crunching, past history, what is the sustainability of the projections, and all of it. So it's more focused on the numbers. Whereas a value consultant or a value engineer is largely focused on the story. They want to make even numbers convey a story and not just simply a figurative information of growth. They'll also make it into a growth story. And that's how story comes into picture when we want to communicate about value. However, one very important thing over here that we have to note is that numbers alone are not interesting and story alone is not sustainable. So if we have to create a value and that value has to seemingly be more than what, you know, uh, it's like value maximization. The value created remains constant, but you create a perception of that value which is much higher than what it has been created. That comes with a combination of good numbers and good story. So a story alone is not sustainable. It won't give you those value. It can't give you any value. And numbers alone are not that interesting that people would flock to get into your business or profession or whatever economic activity that you're doing. So that's something between story and numbers. And as I've mentioned that I've tried to make as many case studies as possible to show or showcase how these principles have been used in the real world and how just following these principles, you can also essentially create value. So the classic case study of value creation is the iPhone presentation. If we were to name one single product that is the most valuable product of the world for any organization or any economy, I think it would undoubtedly go to the iPhone. And since its introduction in 2007, it has been a profit machine and a value creating machine for the organization. But we have to learn how the same product was introduced to the world, and for that, it's extremely beneficial for value professionals to just study the way the presentation was made. I have not, you know, gone into the detail of, or at least it's a 10-minute video that we would otherwise have to see that leads to this. And I would request everyone to watch this after the webinar or whenever you have the time. So I have taken some excerpts from the presentation, and I'll read them out. This was Steve Jobs that made the presentation, and it's widely regarded as one of the best presentations in history. So what he starts with is that every once in a while, a revolutionary product comes along that changes everything. And Apple has been very fortunate. It has been able to introduce a few of these into the world. So first he says that, a revolutionary product, if even once in a lifetime, that's a great thing. Apple has been fortunate to do it for a few times. In 1984, they introduced the Macintosh, and he then puts a story to it that it just didn't change Apple, it changed the whole computer industry. And in 2001, they introduced the first iPod, and it just didn't change the way we all listen to music, it changed the entire music industry. So they backed it up with their past. That's credibility. It's more into the numbers that, they are putting numbers to it that we have established all of it, yet putting it as a story that, okay, this is how we have changed things in the past. So a story backed by numbers is what made that presentation so engaging and so interesting that even today, at least 16 years after it, people look at it in management schools, people look at it, learn from it. And that's one of the most incredible storytelling and number communication that has happened in that. The other thing that the other part of that presentation, when they were introducing the iPhone, the background that they gave was that they were introducing three revolutionary products. One, a widescreen iPod with touch controls, the other, a revolutionary mobile phone, and a breakthrough internet communications device. So the story that they continued to tell, but thus they were introducing three devices, and those three devices were separate devices. And then they come to the conclusion that that's one device, and they are calling it the iPhone. So it's more on the storytelling aspect that this is how the product is coming into being, and that shows us how we have to use numbers and stories to communicate something that is really interesting for the users and the buyers and the customers. So what do we learn from that uh, case study? We saw stories versus number, that's there. However, the more interesting principle that emanates from that presentation is the value versus price. I think we have already seen the value versus price definition, that how much something is worth compared with its price. That's the definition of value. That how does that value compare when it is compared with its price? Now, in real life, what happens is that we have seen examples of it being used by companies. There's value buy, there's value offer, there's, sometimes get more than what you pay for. Now, I fail to understand how is anyone supposedly to get more than what they pay for. Essentially, they get what they pay for. They don't ever get more than what they pay for. It's just an emotion or a feeling that you feel that you have got more than what you paid for. And that feeling is the underlying genesis of value exchange. That the person who is exchanging money for a thing, he should be the one feeling that they got more than what they paid for. And that's how we see in real world, that you will remember the classic example of talk time offers, low kar lo baat, or even the BSNL thing, that you have all of those offers that were offering you much more than what you thought you were paying for. Like there was a there was a benchmark that, 1 minute of call was say 40 paise, and then you move to unlimited in that. So you essentially just look at the direct comparison, that 40 paise into so many minutes is equal to this, and I am going to get this much, so that I'm getting so much more than what I pay for. And that becomes a real value proposition for the telecom company. And I think this is one of the most classic cases of value offers that have been offered. Plus, under various retail communications, that they always use it's a value offer or value buying, or it's kind of they use value as a term to attract people and communicate that you are getting more than what you have paid for. And that is something that has to be understood how it is applied in the real life. Plus, how did Apple did it right in the previous slide? If we were to look at this, how do we understand that they communicated that we are going to give you more than what you are going to pay for? And the background to it was the story that told that you are going to get three products, iPod, a phone, and a communication device. So you would, in your mind, start calculating that an iPod was $400, the phone that I buy is say $500, and then the internet communication device that I buy is another 400. So 400, 400, 500, it's $1,300 of, value that I am going to get. And when the phone is priced at say $600, you find tremendous value coming to you, that you are going to essentially get what you are going to get much more than what you paid for. And that led to people flocking to Apple stores on the day of launch, long queues. I think that's a thing of the past that all the millennials would understand, that we've seen those making headlines. And how that value was created, essentially it was through the combination of numbers and storytelling. So the underlying principle that I want to highlight over here is a combination of numbers and storytelling that allows you to create exponential value. With this, we'll move to the second section of the presentation. We'll shift gears. The first section was discussing some concepts. The second section discusses some principles. So essentially, what we want to understand as value consultants is what makes a business successful. Now, that is the fundamental question that we have to answer. And we need to answer it for our clients also. That how does a business become successful? And largely, if we look at all the explanations that come from management gurus from all the places of the world, we'll understand that most of them say that you do activities that provide value to the others, and that makes a successful business. So, if we were to explain in a single line, you have to create a valuable business. That's what essentially makes a business successful. But the underlying question is that how do you create value in a business and how do you make it successful? So, how to provide value? That's the fundamental question we need to answer. And that's what I attempt to decode in the next few slides. And those slides are something that we need to go into depth of understanding, because that's how I have tried to decode the principles of valuation, something that puts you in a position to understand the principles of value creation. And when you apply those principles in real life, you're sure to get into a position that provides more value. And once you provide more value, people start finding that they are going to get more than what they pay for. And when they start getting that feeling that they are getting more than what they pay for, you start becoming a hot selling product or a service. And what I have also done is focused on professionals, under the case study. I have also tried to see that we focus on ourselves as professionals first and understand that how can we create value in our profession and provide it to the customers, that's the clients, and how clients can feel that they are getting more than what they pay for. And that's where you become something, is as a principle in the coming slides, something that is a differentiator and also something that is not easily replaceable. So that's how you would be able to create value as a professional. And like all things, it's ultimately outcome of hard work, and application of these principles makes that hard work translate into smart work. So without further ado, let's dive into those principles. So what is a value in a business? The first thing that we need to understand is that value in a business or a profession is how it leads to creation of value for the customer. So each of these principles that we are discussing is going to be from the eyes of the customer. So for example, if you are in the business of providing professional services, then the idea is that the client has an effect of either of these things for them to perceive some value in the proposition that you are offering. So, one, your proposition has to either increase their revenue or increase their efficiency. So, it's an attempt to decode. There are multiple benefits that a client can have from your engagement. However, if we were to look at a decoding method of how would you quantify or how would you bucket these approaches or how would you bucket things into these items, you'll understand that first thing from that adds value to the customer is the increase in its revenue or the increase in its efficiency. Like if you give a proposal to somebody that promises the recipient's revenue to increase, then he would definitely find value in that proposition. Or if you just propose something that increases the efficiency of the recipient, that proposition will also find value for the recipient. So we'll take some examples and discuss how these businesses offer a value proposition for their customers. So the first one that comes to mind is marketing. If there's a marketing agency, how does it offer value to its customers? Now, the ideal situation of marketing leads to the generation or creation of leads, and leads to sales, and sales leads to increased revenue. So essentially, the source of that increased revenue can be tracked back to the marketing activity that a business performs. And that's where an agency that offers marketing services can position itself to provide a value proposition that ultimately leads to the increase in revenue of its customers. And with that proposition, that marketing agency provides a value proposition, and that value proposition makes the customer feel that they are going to get more than what they pay for. And that's where the marketing agency succeeds. And so essentially, any marketing agency would provide a value proposition that they are increasing the revenue or efficiency of the organization. So marketing agency's value proposition would be that I would increase the revenue of my customers. The second example that we are looking at is an automation consulting business. Say, for example, if you are into the field of robotic process automation and you provide that value proposition to the client, why would the client actually engage you? What the client finds in it is that you are increasing the efficiency of the client. And when the client feels that I am going to get efficient by implementing this automation tool, they find value in the proposition. And when they find value in the proposition, they come to a conclusion that we are going to get more than what we pay for. And that's going to lead to creating value in our business, because what we get, the value addition in our business is more than the price outflow that happens. And that's where we will be adding economic value in our business. And that's how the ball keeps on rolling. And essentially, the first principle for creating value in business is that your proposition should either increase the revenue or it should increase the efficiency of the recipient, which is your client or customer. The second proposition is directly the inverse, that sometimes your proposition may not increase the revenue of the client, but it can help in decreasing the cost, which essentially leads to the feeling in the client that, okay, this activity essentially will reduce my cost. On the effect of the reduction of cost, my profits would increase, and that's where I find that I'm going to get more than what I pay for. So the second value proposition that the second value principle or proposition that any product or service can have is that it should result in a decrease of cost, or it should result in a decrease of inefficiency for the recipient. So once a product or a service positions itself as a item that decreases cost or reduces inefficiency, that becomes valuable for the recipient. In this, we'll take an example of outsourcing. So essentially, as professionals, we also there are certain organizations that have started providing outsourcing services, and the benefits of outsourcing for the customer becomes a lot of decrease in cost. That possibly they would see that if I were to employ a team of say X number of people versus taking them on outsourced arrangement, then there's a lot of savings of cost that happens. Now, there can also be a lot of inefficiencies that can be eliminated, or maybe there may be some inefficiencies that may increase, and then the cost benefit analysis is done that the increase in the inefficiency coupled with the decrease in the cost, and whether it becomes a net value added proposition for the customer. And that leads to the conclusion that they're going to get more what they pay for, and that relates and results into the creation of value on both ends. The second example, I think, is the most common tool that all professionals use, be it accountants, be it valuation professionals, be it management professionals. I think Excel is one of those. Microsoft Excel is one of those tools that has been widely used, and the fundamental advantage that it has is it increases the efficiency and also decreases the inefficiency, which means that if you were to calculate complex numbers in the past, you would essentially be using either a calculator or manual, and that cycle changed into Excel, and Excel has become better and better and better with every version. And today you can do such advanced analytics in Excel that it's a game-changing thing for accountants and value professionals. So the first two principles of offering value in your proposition is to either your uh, product or service having a possibility of increasing the other person's revenue or efficiency or decreasing the cost or inefficiency. And the third thing that you can possibly offer is to have a risk mitigation, that you can not be offering anything in increase of revenue or decrease of cost or increase in efficiency or decrease of inefficiency, but yet you can offer a value proposition. And that value proposition becomes in the case of a mitigating risk, which is the third. So for example, insurance. If a person looks at insurance as a expense, they would not find that it neither increases revenue, nor does it increase efficiency, nor does it decrease cost, nor does it decrease inefficiency. So insurance does not meet any of the first two valuation principles, but it offers something that allows people to mitigate risks. And that's what the third principle for the customer is, that anything that allows the customer to have a mitigation of risk, that also would become something that the customer values, and they would find value in that, and they would exchange it for the value proposition. They would understand that they're going to get more than what they pay for, and that's how the transaction would happen, and that's how economic value would be added on both the sides. And here is where I have structured the entire thing around the professional. Just like me and you, we are accounting and valuation professionals. So we offer certain services which are essentially mitigating risk. For example, the attestation function. It's more in the compliance domain. And with compliance, the overall genesis of that service is that it is there to mitigate risk. So you would have also come across situations where your clients would be in a position that would say that the work that you do is mandated by the government, and that's where it's more of the compliance function, and that helps us to mitigate risks. And what are the risks is what they would perceive in the business. So a client may perceive that my accounts are very neat and clean, and I have a very good accountant, and essentially I don't have any specific requirement of an audit to mitigate any risk that I have because I am on top of my books of account. And they would not find as much as value that any other person who does not have a good accounting backend would find in the services that are offered, and that entire exercise is done. Now, how do you create value in the eyes of your client? Now, that's the $1 million question that we have been trying to solve. And what we should understand is the principles of these value creation. Now, these principles of value creation, what happens is that as an accounting professional, we are now focusing on accounting professionals. The primary role that the client expects is that of mitigation of risks. And they see that the value that is being offered against our price payment is the mitigation of our risks. And sometimes that may be a priority or may not be a priority for the client, and that's where they may not find that we are getting more than what they pay for. So how does the golden question arise that we are in the field of value added services? You would have come across a lot of discussion around be a value add professional. How are you adding value to the client? Now, how would you know that how are you adding value to the client? So these principles help you decode that as an accounting professional, the first role that the customer or the client expects is that you are mitigating risks. Then when you go overboard and you try to find ways that increase their revenue or increase their efficiency or decrease their costs or decrease their inefficiency, these are the value added services that you are providing because the client did not expect you to perform those roles. And the moment you perform those roles, you can establish that you have added value beyond what the client expected you to do. And in that process, create value for the client, establish that you have worked over and beyond what the client expected, create value in their eyes, and then the client would be happy to pay you because they get a feeling that they have got more than what they paid for. And that essential creation of value as a professional would help you in the long run to become not only successful but also widely respected and sought after. That when we discuss with this person, we always get more than what we asked for. And that's what would create you as an irreplaceable factor. And that would allow you to win the trust of the client. And that's how you would create value in your profession. So that aspect of the discussion was focused around us as professionals. Now, critics of this understanding would come front. You should also put your thoughts to it. Any of the businesses that you think are not going to address any of these three things, but yet they are successful, I would love to hear about it in the question and answer section. And you can drop in your comments over there. We'll discuss it towards the end of the section. I have thought of some that I discuss just, as a discussion point, that a luxury watch manufacturing company, it does not have any of the above three for any buyer. Now, if you buy a luxury watch, it neither increases your revenue as a buyer, it neither increases your efficiency. Why the luxury watch? Because the same thing could happen through a normal watch. Like you buy a 300 rupee watch or you buy a 30 lakh rupee watch, it essentially would have the same level of efficiency, that it would show the same time. And there's no decrease in cost that is happening. There's no decrease in inefficiency as a differentiating factor between those two, nor is there any mitigation of risk that is happening. Now, some may argue that, there are social things that if you wear an expensive watch, there's a statement being made. That's all in concepts. I'm just talking about the bare requirement of meeting the principal test, that how does this luxury watch satisfy either of the three principles that we discussed. In my view, it does not satisfy either of the three principles that we discussed. So how does still luxury watches make profits? How do they provide value to the customers, and how they are successful in delivering value and people still buy them thinking that they're getting more than what they pay for. So if they are buying gold watches, they don't get as much gold as they would have otherwise got. So there's no price versus value, mismatch, that we are going to get more than what we pay for. So it does not meet any of these three conditions. The second such example is of vacations. Now, when we discuss about vacations, there's neither increase in revenue nor efficiency, nor a decrease in cost, nor or a decrease in inefficiency, nor does it mitigate any risks. Yet, a vacation finds value for the customers or the buyers who take a vacation, and that vacation still is valuable and people still take vacations. So what are we missing? Means, how are we not able to crack this under the three principles that we have identified that allow any proposal to create value? Or even as a matter of fact, beauty products, anti-aging products, or those which try to defy uh, things that people just buy them. They are neither going to increase revenue nor efficiency, nor are they going to decrease cost nor inefficiency, nor are they going to mitigate risks. So none of the scientific principles of creating value are being attained in either of these products or services. Yet these products and services find value for the buyer, and those buyers continue to buy these products, also thinking that they are going to get more than what they pay for. So, had it been a live session, it means, in one room, we would have interacted on this, and I would have loved to hear about it. Uh, you can put your thoughts in the chat or the question and answer section. Still, what I'll do is I'll break the suspense and try to decode what and how these businesses offer as value, and what is the fourth principle that you need to address for your business or profession to offer value for the other person. And that is the satisfaction of needs and wants. Now, the human mind is something that's very difficult to understand. At the same situation, someone will work very differently, and someone else would work very differently. And that's something which is a result of emotions. And those emotions are unique to everyone that's participating in a transaction. And that leads to this differential aspect of creating value, which is, you can possibly quantify it as needs and wants. And under various researches, needs can further be quantified into social needs, that you want to find someone or connect with somebody, connect with relatives. If you're staying abroad, you want to connect with relatives, and that connection itself allows you to satisfy your need of a social connection. And that brings value to you, which makes you feel that you are getting more than what you pay for. And same, you have a need to communicate, just for somebody to listen and or meet or share, or maybe just get entertained. Like, if you were to look at Netflix, it does not increase your revenue, it does not increase your efficiency, it neither reduces your cost, nor does it reduce any inefficiency, nor does it mitigate any risk. It just entertains you. And that entertainment is also a need, and that need is being satisfied by such services. And that's where they find the buyers of those services find value. So the fourth principle of the entire creation of value genesis is the needs and wants. That how does your product or service satisfy a need or a want? A need can be just economic needs, a recognition need, maybe some people crave responsibility, that, I want to have a position in the organization that allows me to take some responsibility. Some may just want an achievement in life, that, okay, I should be recognized to get that. And that gives them value. And that value might be more than what money can offer. And that is a satisfaction of their emotional needs or their wants. And that's where these products can command such premium. If you were to buy a luxury watch, the gold and the precious metals that are there on that watch are like 1/10 of the price of that watch. And still it can have that kind of a premium. That is because the human crave for such things. It's a need or a want, or how do we quantify it? And if you achieve that sweet spot, then your discussion about scale versus uh, you know profits comes up. That if you are into that niche, if you are into that area which gives you the positioning to satisfy people's needs and wants, then you are in that zone of value creation, which is the most sought after. That it's something that people crave for. It becomes a necessity for them, and that's where your positioning is the best. It's like iPhone. If we were to look at the iPhone, it has become an aspirational value for so many, and that is the value bracket that everyone wants to be at. That it becomes a need and a want, and people are willing to pay whatever the price they ask for. It gives them social status. It gives them a need. It satisfies all of it. Now, how does iPhone add value? It addresses all the four things. I think it is needs and wants trumps, and then it also helps in increasing revenue or efficiency, decreasing cost or inefficiency. It also helps in mitigating risk. It's the tool that is used for transacting, etc. So as we proceed, we'll also discuss how these things interact, and I have some examples for it under the Indian ecosystem, and how these things take the principles of value creation. So first, we discussed that there are three scientific, measurable items of value creating that your proposition offers either of these three things, and that has to be communicated for the buyer or the customer or the client to find value in. Now we'll take an example of the three Z's of the country, one of which is Zoho. Now, Zoho has a suite of applications. I think all of us are familiar with Zoho, and we know that it's a cloud accounting. If we were to look at Zoho Books as a product, then does it increase revenue or efficiency? I wouldn't say that, except for the CRM or some of their marketing tools, there would be a direct relation to an increase in revenue, but any of the other tools would directly relate into an increase in efficiency. So their value proposition speaks out clearly that once they position their product, in your mind, you would feel that it increases our efficiency significantly. How does it address the decrease in cost or inefficiency? Now, I have known many startups that use Zoho accounting suite as Zoho Books, and that's so easy to use that they save on the entire accounting cost of it. They don't hire an accountant. The startup mentality, the founders' mentality is that, as frugal as we are, it's better. So they do the accounting on their own, and it's so simple that they can maintain good level of accounts on their own, and that helps them to save cost. And with a lot of their automation facilities, it also increases efficiency and eliminates inefficiency. Like if an outstanding email has to be sent, otherwise it would be taking the balance, sending an email, all of it would be manual. And with Zoho, it becomes into an automatic suite, and that creates a decreasing inefficiency. And it also helps in mitigating risks because up-to-date books of account can be maintained, and proper in-time decision making can be done. So if we look at the value proposition of Zoho, it hits on all the three principles. And when you go beyond one principle, so any one principle also makes you valuable, hitting one principle. But if you hit all the three principles, then you are a blockbuster. That's the way you would see that, this is how you would get the maximum value out of your proposition. And that's where you have to aspire to be, to hit all the four principles. Now, we are not getting into much detail on the fourth principle with the three Z's example. We'll look at it from a different perspective in the next set of examples that I have taken. However, it is something that I want to communicate to you to understand these principles. It's more about getting to understand that how customers perceive value. The next example is Zerodha. I think a lot of us would have already used Zerodha, and you would see that they they put a value proposition that we will allow you to increase your revenue if you participate in the market. So it's something that they don't put, but it allows you to increase your revenue. It's not a claim that they make. Yet you feel that, okay, this allows me to have that increased revenue. It definitely decreases the cost because their brokerage policy is such, it's kind of zero in their name. And that's where you find a value proposition, and it allows you to mitigate risk because of the community that it has and the information that they share and the analytics that they give for the scripts and the services of or whatever they offer. So they also hit all the three principles of value creation, and that's kind of why that product becomes so valuable for uh, the for the customers. And the third thing, the third Z that we are going to discuss is Zomato. Now, people would be in a position saying that Zomato is into losses, etc. That's one way of looking at it. Numbers, right? That's there. Now, where's the story part of it? We need to understand one thing is that how does a startup differ from a brick and mortar business? The first thing is that there are users and there are customers. So for a startup, a user is somebody who uses the application, and the customers are somebody or the organizations that are actually paying uh, customers or users or partners. So a classic example is Instagram. That users scroll through Instagram, they don't pay anything, they are just the users. They form the entire ecosystem of the reach, the data that Instagram has. And then the paid sponsors or the paid advertisers on Instagram are the customers or the customers for Instagram. So that's where we just need to understand the difference between customers and users. And for Zomato, the restaurants are essentially what I would say that the customers are, and we are the users. So for the restaurant, does it increase the revenue? The restaurant would want to believe that yes, being on Zomato allows it to reach a set of users that were otherwise not possibly wanting or having knowledge of their restaurant. So that's a possibility that there's an increase in revenue. Does it increase efficiency? Well, yes, if there's an entire online ordering ecosystem, then the operator doesn't have to be engaged into taking orders. Simultaneously, multiple orders can be placed. So that also allows them, there's a value proposition on both increase revenue and increase efficiency. They also have a value proposition that decreases the cost because the cost of operating a delivery network and making so many deliveries for a restaurant would necessarily have a higher cost base than what it gets from its participation with Zomato, and that is a win-win for the restaurant. That it decreases the cost of them reaching to so many customers, and it allows them to mitigate risk. That if in a time like COVID, if people don't want to go to restaurants, at least they can order in, and their business keeps on running. So it also has all the three value propositions, and that's where the economics of that value proposition are not yet there. We look in the following slides. I have made some very specific startup related observations on value creation. Now, that being said, how does Rolex as a watchmaking company, how does that uh, have a value proposition? As we saw, it's about wants and needs. It does not have any of the above three, identifiable principles of value creation, but still it becomes valuable. It's a social statement. It's what users have needs, and the customers have their needs, and that's what leads them to perceive value in what this company offers. Similarly, with LVMH, if you have to ever buy a product of LVMH, in Indian rupee terms, it starts with six figures. And uh, does it have any different functionality than what a regular thing would offer? And the answer would largely be no. But still, people have that emotional want of getting these products, and that's where they pay whatever the price is. So they are into that sweet spot of uh, still not as sweet as Apple, where their products have become more like a crucial necessity for many people in their minds, and this is more like a luxury necessity. So that's kind of a separate positioning. And something like Porsche, if you would were to look at cars, a car would take you from one place to other, and the same would be with a Porsche. But the value positioning of Porsche would be quite significantly different, and that's where the needs and wants of people would drive that differential decision of moving to a Porsche than to any other car, and possibly the same three principles, but the positioning and the value would be entirely different. So that's an attempt to put forth the principles of value creation, and that's something that I wanted to spend the most of my time, because that's essentially how principles of value creation come into play. With that, what are the value drivers in an organization? So, if we were to understand how we were to advise our clients, or how we were to even look at any organization and say or guide them that, okay, see, this is the value driver in your organization. Focus on this value driver, and you will be able to create value. And that's where I've tried to put some examples again. So I'm not I've tried to make it as interesting as possible with real life case studies or real life interactions, so that these principles can be better absorbed by everyone. So the first thing is product and service offerings. Now, when we look at a product or service offering, this can be the value driver if it is so different and so well positioned, and it really has that edge. So sometimes you will know, in professionals, there are certain doctors who are really good at their service. Means, if there's a surgeon who is the best known surgeon for a particular heart surgery, then he'll always have the patients, right? And at the same time, he may not have the best infrastructure. So if we were to look at the overall proposal of finding picking all the boxes that they have to mitigate risk, this all of these principles, they may not, that clinic or that setup may not have the best positioning, that in all terms, but their hero service, if the bypass surgery of a surgeon is so well known that he has the best hand or she has the best hand, that essentially trumps every other thing, and that becomes the value driver of the organization. If that, coupled with all the other things that bring together a service, that's the secret sauce for the success formula. And you have to build on that value driver. That your strength is this particular item, which is the hero service or the hero product. And that's what you need to build on. And that would give you the differentiator that everybody aspires to have in their organization. And that would create the strongest value proposition, and people would flock to get a part of it. The second is skilled employees. So, for example, if the services that an organization provides, say, for example, an outsourcing service, then outsourcing service is something that is very competitive, and there are a lot many other service providers who are providing the same service, and there's not much of a differential in the quality of the services that are being provided. So, essentially, what happens between the two is that these skilled employees become your value driver. That continuity of the same people on the assignment. Maybe even in large IT companies, you have a lot of staff turnover ratio. They definitely have some hero services and products, but they would also have one of the biggest resources, or one of the biggest value drivers would be their set of employees, which is the skilled employees. So that also can become a value driver for an organization, and that would essentially be the focus point of efforts to create value. The third thing can be a customer base. So over the years, many businesses that have been there are having a strong customer base, and there's always a cost of shifting associated. So, for example, if we look at Tally as an example, then I think the biggest advantage that Tally has is its customer base. It's a huge customer base, and there's a shifting cost associated with it. So, when we look at their value proposition, for them, the value driver is the customer base, along with a very good product or service. But essentially, that customer base drives the value. People can uh, relate that okay, it has a very strong customer base, and that's the value driver. They have to build on that, and that makes them in a irreplaceable positioning in the overall drivers of value. The fourth is the market environment, being at the right place. I think nothing trumps this. For example, if you are setting up a snack shop and you are going to sell snacks, and so the biggest thing that you want is not a hero product or a service. You don't want a skilled employee or a customer base, but the thing that you want is a market environment, which means that if I have a hungry crowd, then that's the first thing that I want. And that trumps everything. So your location, your positioning, the time, everything comes into the market environment. The strategic vision, I think this is like you have been running your organization in a very intended manner, that the direction is clear, where you are wanting to go is clear. So that makes you a very well positioned organization in the long run, and that makes people see significant value in the thing that you are running. Then the new age concepts, these are now coming as value drivers, which is scalability. Now, if we were to look at VCs, Ps, then the first thing that they look at, how scalable is this? You have all the value drivers there, but how scalable is this? How do you scale this? And scalability has become one of the most sought after value drivers today. That okay, if you have a problem solving solution, then how can you scale this? How can you reach as many paying customers as possible, and how fast can you do it? So that's about scalability. That if you have a scalable product, then there's already some value. Dream outcomes. I think this is now becoming a key value driver. That how essentially can you achieve people's dreams, and how can you contribute to them achieving their own dream. And that's what makes these businesses and these things become more and more desirable. That okay, I can. So it's like the name itself, Dream 11. It's like it's kind of I don't endorse anything of it, but it's something that is promising you to have a dream life and kind of winning money out of that thing, and that promotes a dream. And once you have a promising some dream outcome for the user or the buyer or the customer, then definitely it brings significant value to that organization. The next thing is disruptive ideas. Now in the further part of the presentation, we are also discussing a corporate life cycle. So that's where we'll discuss more about the disruptive ideas. But it is something that's the most attractive thing for investors. It's kind of a disruptive idea that changes things. It's never before, and we'll discuss more of it when we come to that corporate life cycle. And then comes technology. That if you have a very strong technology, then there's so much value in your organization, which we'll just understand in the next slide. And that brings a great value driver to you. So certain concepts we'll discuss, where the second part is what technology we'll discuss. The capital versus labor. I think as accountants, we are all aware of capital's role and labor's role. And what happens is till the time there's unemployment, there will always be labor that will be available, and that's a replaceable factor. And capital would always have the value that it has because of its limited availability. And at the same time, so I'm not going to discuss much on that. Let's focus on the second part, which is differentiability. Now, differentiability is something that you have your aspiration to achieve, a differentiable product or a differentiable service that makes you set apart from the rest. That is something that would bring you significant uh, value, and the perception would be just multiples. Now let's take an example of Intel, Microsoft, and Dell. Now they are in the same ecosystem. If we were to say that computer systems, Intel makes the microprocessors, right? So the chips that go into the system that are made by Intel. Microsoft makes the software and Dell makes the hardware. Now, it never was this way. Microsoft could also have gone into hardware, and now it has already been making Surface laptops and stuff. But let's look at the history of value creation. Now, if you were to look at Microsoft, then that's the smartest player of the three. It built the software on which everybody would get dependent on, and then Intel as a chip maker would continue to make chips and they would have their own value proposition. But Microsoft would leverage that value proposition, not have that investment, and still take the most benefit out of it. And similarly, Dell would make the laptop, sell the hardware, but still they would be dependent on the Microsoft software for it to, have a meaningful value for the customer. So Microsoft then built an ecosystem for apps, for all the other things that uh, add value to the customer. And that's where it benefited from all of these ecosystems, and it differentiated its ability to be that entity. Similarly, automobile companies, I think as accountants, you all are aware that how they operate is through the OEM model. They are not essentially the full manufacturers of the car. They manufacture the heart and then the rest of it is just sourced. But still, how is it that the value gets concentrated on the automobile companies and not the OEMs? Like the person that's making the airbags for all the companies, possibly nobody knows them, but still everybody knows that a car is either a Toyota or a Mercedes or a Porsche, or those are the brands that are known, and may not that's just a combination of OEMs at the heart of the car. So the biggest factor that drives this is the trust that people have in these brands. If there's a fault in the car, then Suzuki will recall all of the cars, and they'll not say that means in the internal arrangement, they may have a corporate warranty on the supplier OEM. But to the world, they'll not say that, okay, our OEM failed, it's us who failed, and that's why we will recall the cars and we will do the replacement. Now, who bears the financial brunt of it? We are not aware of the front end of it. But typically in the front end, we know that Suzuki called back its cars or, whichever. So that gives the trust, and that trust drives the value. And trust in any business or profession is paramount. Once you develop that trust in the customer or the user, you'll definitely have that value that is created. The second thing is value creation versus value capture. Now, that's where differentiability and replaceability come into play. Differentiability is your ability to make a separate position for yourself. In a crowded market, you can stand out, and that makes you a differentiated service provider or a differentiated business. And that makes you irreplaceable, and then you have people who would follow you and try to replace you. For example, if say you are a good consultant in valuation, then you have already created a differentiation for you that we are value engineers and not just compliance professionals. And that makes a differentiator for you. And then people would follow and try to replace you. Don't be the person who tries to replace somebody. Try to create a differentiation for yourself first. So that's the concept, that the size of the pie first and share of the pie second. Try to create your own pie rather than cutting an existing pie, because cutting an existing pie essentially will just have your market as limited, as well as you will not have any differentiation factor, which makes you replaceable. So just like you position yourself as a replacement to somebody else will position yourself as a replacement to you. And that essentially is something that you should avoid. So you shouldn't try to capture value, you should try to create value. And that's something that is a very key factor for as a basic factor for your creation process of value. And then there's the concept of value chain, which essentially is that it's not the business itself, but it's all the stakeholders that become a part of the value chain, the suppliers, the customers, the overall ecosystem, the environment, and your entire stakeholder community that you have to keep in mind while you try to create value for yourself. So, what are the steps of value creation? Well, the steps are pretty much you have to ideate a concept. You think that there's a service or a product that will add value. You ideate it, then you evaluate it that whether it meets all the principles. How is it meeting all the principles of value creation? And then you implement that idea into your product or service. You create that product or service, and then you adapt and change. I think adapting and changing is the most important stage of value creation, because once you implement, you get your initial values. That's the trigger. But then you have to maintain and sustain it. And for doing that, you need to keep on adapting and changing. And that's what takes you to the next level. So, what is the corporate life cycle? And this is what I was talking about when we were talking about disruptive ideas, right? So, if we were to look at a corporate life cycle, we'll look at startups. That's the most common, terminology for an entity that has a disruptive idea. So, the first stage of a corporate life cycle is that it has a disruptive idea, and they start with that disruptive idea, and that brings them significantly in a very high growth phase. Just like a rocket that takes off, and that phase of the startup's life cycle is essentially something that would be a key phase for them to keep growing customers, have great traction, and people would get to know about the startup, and that would be a crazy journey. Once that initial phase goes away in the corporate life cycle, you have a very young growth phase. A young growth phase is somewhere where people are still clinging on to the product, and you have still some hiccups that are there, some troubleshooting that needs to be done. But that's a good phase to be. You already have an established market. You already have good customers, paying customers. You are into a positive zone, and that young growth continues till the stage of maturity, where in a maturity phase you have now established yourself. Ye- Yeah. Hello. Okay. Yeah. So I think there's some disturbance. That's not. Let's look at maturity phase. When we are looking at the maturity phase, essentially what happens is the businesses that reach the maturity stage have a very good product. They have a very good customer base, and they are making good value proposition. They're exchanging good value, and they're creating good value. But the problem with it is that there are market forces that come. With that comes the replaceability of the product, that other people are trying to make it better, cheaper, faster. Means, there's more efficiency in somebody else's product. They are more faster than you, and they are essentially cheaper than you. And they make the replacement move in the market, that they want the replacement part of it. That once you are mature, they want themselves to be your replacement, and once they target that replacement, the mature business can possibly come to a decline. At that stage, again, the adapt and change principle would allow the mature business to have a disruptive idea and again start the curve from maturity to high growth, and startups and young growth, and again maturity. And then again, you need to continue disrupting. That makes you continue to make a differentiation for yourself, because the moment you differentiate, it's the start of somebody who is starting to replace. And when they come, you have to again disrupt and become the differentiator. And unless you do that cycle and cycle again and again, there's no continued life cycle of value creation. It's a one-time life cycle that you move from startup to young growth to maturity, and then you may possibly start declining. And that's where adapt and change, that is the fundamental principle that would allow you to move into a zone that would make you have a disruptive idea and then again go up from maturity to startup to young growth to maturity to again startup young growth maturity. And that's the virtuous cycle that you want to be in. And for that, it's a whole effort that would take. And we'll take some examples to understand this corporate life cycle, and these are real life examples and they're very well known examples. So I think immediately you will be able to relate to it. The first example, I think this is a phone that all millennials would know. I don't know about Gen Z. Gen Z may not recognize this, but millennials and all people before would understand that this is a classic Nokia phone, which was all, when it came out, it was like the thing to have. I remember my father had one and it was like the coolest thing that we saw, and it was disruptive because it was a presentation or a feel that a laptop could be carried in your pocket, and that's what made it so unique and people aspired to have it, and it was a success. But what happened to this, that it went from the three stages, but then it started declining, and the disruptive idea at its maturity did not emanate from within the organization, and somebody else brought that disruptive idea and they took over the next cycle. So that's how this, understanding the cycle is also very important. The same thing happened with the iPod. As iconic or as revolutionary a product it was, it had its own life cycle, and at that time the same organization had the disruptive idea, but it was not the same product, and that's where the organization could survive, but the product life cycle came to an end, but the corporate life cycle continued because the disruptive idea at maturity originated from within the organization, and that's what helps the organization to be in a virtuous cycle of value creation and not just the vicious cycle. And you'll understand that this same thing is also a very base genesis of M&A transactions. If you would understand organizations taking this route, you would essentially understand that this is sorry essentially M&A activity also is the source for this. Like, people who are at the maturity stage would look at other avenues, and maybe that disruptive idea is from within, that's good. If it's not from within, they'll go loggerheads to acquire it because they want to continue in the corporate life cycle. They don't want to be in the declining stage. And that's what is a very important thing to understand. Same with Amazon. If you were to know that Amazon started as an online bookstore and then went on to become what it is today. And in middle, they found that the scalability that they are achieving with their product about the cloud computing was something that they could convert into a business. And they shifted, they no longer remained a bookstore and they moved into e-commerce. Similarly, with Netflix, they were into the business of renting DVDs, and from that they have become the world leader in over-the-top content. So that is something that is also a shift of change. When they were at maturity, again a disruptive idea came, and they catapulted from there. And the same is with the Indian T series. If you were to look at, they were also cassettes. And then they understood that now if we don't have another disruptive idea of, getting online, getting into the way consumers consume content, then we'll also perish. And you would have multiple examples of businesses that have perished because they could not move from that maturity to declining stage and not have another disruptive curve. So that's some examples to correlate. Now, I think there are three case studies, and I think I have 10 minutes, and then I have the formula. So I think I may not be able to cover everything. At the initial part, I was thinking that how would I be able to complete 2 hours on this, but now I think I'm running short of time. And So I'll tell very briefly the case studies. There are two doctors, Ram and Shyam, and they are essentially doctors. And Ram treats the patients for fees for several years and has a well-established known clinic of its own. Ram has very high margins, For every 100 rupees that he collects from the patients, he keeps 70. And for Shyam, he has built up a practice which is now, kind of multiple branches, multiple places. And for every 100 he collects from the patients, he keeps 40. But Ram is able to collect 100 and Shyam is able to collect 1000. So Ram could keep 70, but Shyam could keep 400. Now, who created value in this? Both of them had the same thing. Everything was very similar, but one chose a path which was, kind of high margins, and one chose a path which was reasonable margins but high volume. Now, if we understand the concept of value creation, the first case is that of income creation. So that Ram has created income, but he has not been able to create value out of that income. And Shyam has created value because he could exchange this entire effort for an investment, or he could possibly at retirement sell this practice. Whereas Ram, if there is no succession in place, he'll only have the option to phase out the practice and he'll not have any specific value creation coming out of the case. So the second is Reeve and Pranav. Both have set up something which ticks the value principles, right? Engineering plant, it ticks amongst the three principles. NBFC, both tick amongst the three principles of value creation. However, in the engineering plant, they came across a lot of bad debts, and Reeve had to close the plant, and he actually lost money in the process. Whereas Pranav had started an NBFC, and that went into a position where he could make money and grow the capital that was invested. So, with the same principles, both were aware of the principles of value creation, everything remaining the same. One failed and one prospered. That essentially brings us to a concept which is dependencies, external factors. Now, internal factors also, external factors also. Dependencies can be both. Internal is that you don't have efficient operations in your organization. That essentially becomes something that is a dependency which is internal. And the second, external factors, like had means COVID as an example. It's an external factor now. A restaurant cannot do anything about it. It just happened and everybody is facing it. So those external factors are there. Similarly, for Reeve, it was the debtors. They turned bad, and that's what led to the loss of capital. And another dependency, if we were to look at, is an example of backlash, or backfiring. You have a disruptive idea, but you implement that idea and the market backfires. Like the target buyers don't find the value that you are putting forward, and your product fails. And the another example of external factor is the timing. Like I read in a book that Ritz Carlton set a chain of hotels. They were like pioneers in introducing the plastic cards for locks. And when they introduced it, the guests were not able to understand that how can a hotel of such standard not afford to give physical keys, and they are giving us some cheap plastic. And that's where they had to change the entire locks because the timing was wrong. The world was not ready for it, and they introduced it, and they had to kind of just fail on the timing. So timing also is an external factor. Now, this is something that is startup focused. How would a startup like say Nivan Technologies, they have something that is there's users, there's customers, and based on the users, they have a conversion ratio to customers. Like a user becomes a paying user, and that paying user is a customer for them. It's like a freemium model. And how do the factors like business costs? Business costs are the operational costs. These are the operational costs for the startup to operate. And then there are the user acquisition costs, that how much are they spending for every additional user, not a customer, user. And then what's the lifetime value of the user, and then there's the user status as to whether they're repetitive or casual. These are some terms, and I think we all are aware of it, so we do not spend much time on it. However, the important matrix for a startup, that's what we would look at, that the cost of acquiring a new user compared with the profit per user. Like if the cost of acquiring a new user is low and the profit per user is low, then it's an average business. If the cost of acquiring is medium or high, but the margin or profit is low, then it's a bad business. And if the cost of acquiring a new user is low and the profit per user is high, then it's the greatest business. And that's how the matrix is. So that's something that startups and the entire ecosystem has to crack for creating value. This brings us to a very interesting part of it. How can you become a value professional, or how can you become a value engineer or a value consultant, or how can you add value to the businesses that you help? So one, I think the biggest role that a value consultant can play is to guide businesses understand the corporate life cycle and help them in changing and adapting. I think this is one of the most important value addition that you can do in any practice that you do. Make people aware of the changes and make them adapt to changes that are happening. Like if today if you as a professional are not adapting to artificial intelligence, AI, then it's something that you are wanting to go from the maturity curve to the degrowth part of it. As a practice, you yourself has to as a practice, you have to adapt to AI. It's something that you may agree or not agree to, but the world is moving in that direction. So that change or adaptation is very necessary. And the way you adapt, you lead by example for your clients, and your clients also you propagate that, this is a change that is happening and you need to adapt to it. Don't remain primitive. None of those other things would matter unless you change and adapt. So even if you have a hero product or a hero service, you need to continuously improve it. The second is understanding the risks to sustainability. The moment you see your client in the corporate life cycle at a mature stage, you need to understand that this maturity is not going to be forever. And you need to start guiding your client that, start for a disruptive idea, either look inside or outside, go do M&A activity. Wherever in your field there's something that's happening, now you have to be in that continuous improvement cycle. Identifying the value driver of their business is worked on. Sometimes clients don't know what the value driver of their organization is. So you need to play that role, understand customer behavior, understand what is it that is driving the most purchasing decisions of the customer. Work on it, enhance it, provide it as a service to the customer, as a client, and then the client serves the customers. Then managing their business to be synergy ready. Sometimes it's more that people have a succession issue. They don't have anyone to give the business to, and they then need a planned manner in which their business can be brought to a stage of succession wherein there are buyers, and then you identify what synergies would anybody look at for acquiring it, or how is it reverse, that if you have to buy something, then how are you managing your business in a synergy to acquire that business, kind of synergy consulting. People and businesses want their value to be more and more. It's an aspirational value that people have, that they want their business to be more and more valuable. And that's where you have a very good role to play. M&A activity, you can aid in it, because once you understand the concept of value and understand that trade or transactions happen on the underlying principle of value exchange, you can be a M&A advisor, being value unlocking. You can make preparatory stages. Like if you know that your client wants to do a transaction on the sale side, then you can help them prepare for the sale, make a good story, capture numbers, capture story and numbers, and make it into something that is attractive to a lot of people, where they can find the value that they are going to get more than what they pay for. And obviously, please remember my original suggestion: no false statements, no window dressing. That doesn't sustain. And you, just like I have tried to make you all understand about the principles of value creation, you can go forward and explain the same concepts to your own clients. Ma'am, how much time would I have? There's this value equation that we want to discuss if we have the time.
I think it's a very good session, and all participants are interested in knowing further also. So you can continue with this. And then,
Okay, great.
please,
Thank
because
you.
it will be very helpful to them. Then. Yeah.
So another 10-15 minutes is okay, right?
Yes, because because
Sure.
question answers also we have to cover, but I think that we can take extra 10 minutes if the participants.
Okay.
Yeah.
Thank you, ma'am. So, what in history, what the greats have done is they have captured things in equations. If we look at Einstein, if we look at Pythagoras, if we look at Black and Scholes, we understand that they have tried to capture ununderstandable things in equations, and that's what has made them great. The equations and the formula that they've given to the world for people to follow, and that's where all all value professionals are trying to capture value in an equation, and there are two specific formula that I like. So the first, the principles of value creation that I've explained, the 3+1, which is the revenue, cost, risk, and the dream, or the needs and wants. This is something that I endorse the most. That's one way of putting an equation to value creation. The second one is by an American guy. What he says is that value, if we were to present as an equation, that value is a dream outcome multiplied by the likelihood of achieving the dream outcome, divided by the efforts and the time. So this is one of the most interesting analysis of trying to put an equation to value. I really like this approach. So what's the four parts, right? It's dream outcome, likelihood, efforts taken, and time taken. If we look at this, there are two in the numerator, two in the denominator, which means essentially, if we were to look at the first part, which is the dream outcome, then how does this part of the equation of value work? The first example that comes to my mind, and we'll discuss that across all these four, the more value proposition that your product or service has in increasing the numerator and decreasing the denominator, the more value it is, the more value it can have. So one is the dream outcome. I'll discuss this in the context of a very recent drug that has been discovered. It's a Novo Nordisk company's Rybelsus. So that's a drug that has been discovered lately. It's a drug discovered, means it's partly by accident that they were making a sugar control drug, but they have went on to make a weight reduction drug, right? And that weight reduction drug is known to have the least side effects, that it only leads into some sense of nausea and vomiting in a lot of in a select sample of their clinical research trials. And that has made a dream outcome possible, that by just eating some tablets you can have a significant loss in your weight. Now that loss of weight is a dream outcome for many, so they have hit the first box spot on, that people want to get slim, people want to reduce weight, and that drug hits that dream outcome very, very well. The second is the likelihood. Now, through proven research, that drug has a very clear value proposition, that they are hitting it the right spot, that they are getting results in almost all the cases of clinical trials where there's a 5 to 7 kilo reduction just by taking medicine, no other activity, other thing. The third is the time taken. So they have a clear demonstration that in 2 months you are sure to have that weight loss, because it's proven through clinical research and the trials. And that reduces the time taken to get your weight down. And the last thing is the efforts. You just need to swallow a tablet. If we just look at any other weight loss method, it is significant efforts on either physical activity or reduction of your intake. So this hits all the four quadrants of value creation, and that's just a significant way in which this equation works, that you have a dream outcome and the likelihood, the more you improve it, the more you increase it, you have a better value. The less the decrease in efforts and time is what would also make it more valuable. So again, either of the four, any one of the four, even if it is hit, you have a value proposition. If you hit all the four, you have a blockbuster. So this just the same way, how the first four principles we discussed, these are the other four ways of looking at it. Now, there's a Harvard iLabs also study that makes that how do you create value? And this is the problem solving approach, right? A lot of startups have that problem statement to start with. What's the problem statement? How does it solve a problem? Now, this is one more way of answering some set of questions which allow you to have a value creating proposition, that if the problem is unworkable, kind of the Tesla Cybertruck, if they had a demo and the bulletproof glass that breaks by the baseball, the ball that was hurled towards the car, and that broke the glass. And whenever advertising it as a bulletproof glass and that breaks on stage, it's an unworkable problem. If you solve that problem, then Tesla is going to pay you like anything. But that becomes like anything that is unworkable, like an uptime for a e-commerce company. If you solve that problem, then they are going to pay you. So an unworkable problem, if you solve it, that gets paid well. An unavoidable problem, so taxes, any compliances, all of these problems are unavoidable. And if you solve some problem or make them better, then also you have a value proposition. If it's an urgent problem that you have to solve, for example, it's the classic case is the ice cream vendor next to a picnic spot. People just have the urge to have ice cream. It's an urge, and it's an urgent urge, and they'll pay anything to have that problem solved. And the fourth is if it is an underserved problem. For example, if we were to look at the matrix in India and there is a healthcare problem which is underserved, and if you are solving that problem, then also you have a value proposition. So that brings me just one step before the closing. I just have one more thing to share. And that is that how has value creation been happening till now, and how it is changing now. So see, history has shown that there has been immense value created in the past. Some examples: John T. Rockefeller. If we are aware that he is known to be the richest guy in the history of mankind at a relative basis, like percentage of individual wealth to total wealth, that guy has been the richest person in the history. There's Henry Ford, who has created that kind of a wealth in the past. But what is happening today? Today, economic wealth is one part of it. That part of economic wealth. So history was focused on economic wealth, but today the entire value creation landscape is changing from just economic to environmental, social, and governance. ESG in addition to economic. And I think we all are aware how the regulations are coming up and shaping up this overall responsibility of businesses. And that's one more concept that I need all of you to appreciate, that in today's world it's not just economic. You need to crack economic, but you also need to be aware of ESG and have a value proposition that solves or at least addresses these ESG risks also. And that's where the entire value creation would be enhanced for all of you. And with this, I thank you all for your patient listening, giving me the gift of your time today on a Sunday morning. And I think I hope I have added that value to all of you and delivered more than what you sought for the 2 hours that you've invested in this webinar. And I'm happy to take any questions. I'll stop sharing my screen.
Before we start the question answer session, I will request all the participants to fill the feedback form as a link which is given on the webcast screen. It's coming to question and answers. First is, do you agree with that value can be created by giving hype about a company?
So again, so I'll tell you, hype as a marketing strategy is completely different. If we create a hype, just like if the entire world is aware that on the 15th of this month, Apple is coming out with another product. So that's the hype that they create. That's the marketing side of it. If the hype is a false claim and it is not backed with the value proposition that people find or seek from the product, then that becomes a challenge. So that's where any false promise that is made, any hype that is just falsely created, that will just have the initial traction, but in the life cycle, it will simply fail. Won't even reach the young growth. It will just be on the startup phase and then directly degrow. So hype as a marketing strategy, yes, but as a value creation, no.
Next question is, economic value added is after recovery of cost or any value addition.
So economic value added is definitely after cost, means it's the net value that you add, kind of inputs, outputs, the difference between that is the value add, and then that over and above the cost of capital is the EVA, which means VA is equal to output minus input, and EVA is output minus input minus cost of capital. So that's how we'll put EVA.
How can business adapt their value creation strategies in response to changing market conditions and disruptions?
So how so that's more strategic in nature, that where are they looking to have their value proposition based on, and those changes, it's more of a internal quality. It's kind of, if we look at the Nokia case, they were also aware that people are having changing behaviors, the customers are having a changing behavior. Now if their principle is that what we have been doing is only right and the customers are fools and they don't understand how to use soft devices, then that fails. It's more to be customer centric. It's like more to learn from the Amazon story, that whatever happens, the customer is always right, and what they want, we have to deliver. I think that approach only would bring people to have that change and adaptation to be in line with what the market wants. So I would say that the market is not what others are doing. Market is what the customer is wanting, and to satisfy that would be the most important factor to have as a change, or as your adaptation to it, and not what just others are doing, so I'll do. It's more like what the customer wants and I'll do.
How does effective leadership and organizational culture contribute to value creation?
So this essentially is the most important part. I think leadership and organizational culture, these are the fundamental principles. Now, this is something that helps you sustain, this is something that will help you have a sustainable approach. And how do I scientifically put it? See, leadership is a abstract quality, and some people are born with it, some people develop it. But those who are born leaders, they just outshine others. And those who try to adapt to leadership, they have a good way, but they have to learn it through the way. And I think that's an abstract quality which would obviously have the most differentiating factor. But I would say that on a scientific principles, that's a given, that leadership, organizational culture, all those are the abstract intangibles that would obviously and put more value to the table. But that's something that I didn't discuss today because of me trying to kind of codify the principles of value creation, and not talk on those abstract principles that obviously are there and like a basis of value creation.
What challenges do business commonly face when trying to create and sustain value?
So the most challenge is the, what I say is the resistance to change. I'll give an example that if I start a hero service, right? For example, I just start valuation and I just become very successful at it. Then in my mind, what happens is that I have been successful doing this, so I'll continue to do this only. And that essentially, that arrogance, that resistance to change is the beginning point of the most critical part of the life cycle, which is adaptation. And getting another disruptive idea when you are at maturity. And most people fail to recognize that their own ego or their own understanding of business, where they drive the business, is the starting point of their failure. Means they miss to understand what the customers want, they miss to interact with the customers, and they miss to understand that aspect of the business, which is the most critical one for businesses to create value in the long term and continue to sustain. And I think that is the most challenging part of any organization in creating value.
How social media adds to the value in profession.
So social media is, see, I say, if in profession, so if we were to say other than CA profession, like where we are not having that, social media marketing powers, but for other professions or other practices or services where social media can act as a marketing tool, which leads more recognition, more people having to know what you do, and then allowing that benefit to come and increase your revenue. And that's where you will find some value proposition in that. As professionals, I think under the code of conduct, the more knowledge you share, the more people become aware about what skills you have, what understanding you have, and that possibly brings you, uh, you know, some work. And that's how, in the principles of creating value, I put it to the increase in revenue, or and want or need satisfaction of recognition, that people as professionals want to be recognized. And I think those are the two principles that social media would hit.
So this was the last question received by us.
Yeah.
See, Deepam ji, it was a very wonderful session given throughout.
Thank you so much.
You have given the thorough insight of creation of value. It was very excellent delivery, supported by good presentation and related case studies. You have given an example of the case study of iPhone and how it was like the three devices were combined into a single device, and explaining how we get a higher value of what we have paid for. Then you have also explained the value in business principles like increase in revenue, efficiency, decrease in cost and inefficiency. Then you have given the examples, use of Excel. Then you have given examples of then watch, then vacations, beauty products, like where explain the concepts of principle relating to needs and wants. Then the Netflix, the 3Z, Zoho, Zeroda, and Zomato, Rolex, LMBH. So you have explained the value of equation. Explain the value equation, like, what exactly it is and how it should be. And you have done complete justice to the topic and created value today for all the participants, including
Thank you.
your deep insight and explanation for a single word value. I would say
Thank
it was
you.
too good. And in fact, the best and excellent will be an understatement. And I'm sure it would have benefited all the participants, and all the queries received were instantly addressed. And I hope that the participants are satisfied with all the explanations given by you. And I present a hearty vote of thanks on behalf of the Valuation State Board of ICAI and all the participants. Thank you, C.A. Deepamji. With this, we come
Thank
to
you, ma'am.
today's session. And thank you all, and have a great day ahead.